Trump's tariffs on Canada, Mexico, and China took effect Tuesday, and stocks are selling off for the second consecutive day. But they're not all down to the same degree, and the heaviest losses may be signaling where tariffs will bite the most. For one, large companies are holding up better than smaller ones, presumably because larger companies have more market share and related pricing power, which makes it easier for them to pass on the cost of tariffs to consumers. The Bloomberg U.S. Large Cap Index, which tracks the largest 500 U.S. public companies by market value, is down 3.2% so far this week. But the Bloomberg U.S. 2500 Index, which tracks the next largest 2,500 companies, is down 4.8%. It's not only size, it's also about which companies are likely to take the biggest hits. Given the types of U.S. imports to Canada, Mexico, and China, notably energy, autos, machinery, and electronics, the tariffs are more likely to affect energy and manufacturing companies than, say, tech companies. Most of them are companies people have never heard of, like Permian Resources, a Texas oil and gas company whose stock is down 10% in 2 days, or Cleveland Cliffs, an Ohio manufacturer of steel products with operations in the US and Canada. Its stock is down 11% in 2 days. That also explains why larger companies are holding up better so far. Fewer of them are directly in the path of tariffs. 28% of the small cap index is made up of companies in the energy, industrials, and materials sectors, while those sectors are just 13% of the large cap index. On the flip side, tech is 31% of large companies, but just 12% of smaller ones. And yes, tech is holding up better so far, although it's down as well. My takeaways from the market's reaction this week are that 1, companies will have to absorb some of the cost of tariffs because they won't be able to pass all of it on to consumers. And 2, if you want to gauge the impact of tariffs, don't look at headline stock indexes that focus on the biggest companies. Dig deeper.